Hey, welcome to Financial Revelations. I am David Safransky. Exciting news this morning. I woke up. I live on Lake Erie, and every day's a new day on Lake Erie, whether it's turkey vultures dropping dead fish in your yard or just dead fish all over the place. But this morning, one solitary bird out on the jetty was a bald eagle. And I thought, praise God, it's great to be living in America, free, capitalist, in a world where you could be anything. Be a free market capitalist. It's the kindest thing that you could do. It teaches people to build, to work, to invest in the future, to give. America gives away more money than any country, ever. If it wasn't for us, most of the world would be in poverty. If it wasn't for America. America is the most generous nation ever. And it's you guys giving away, going to the Amazon, going to mission trips, going to Africa, Mexico, rebuilding things here. We do that. God has blessed this nation. Don't forget that. 1-800-344-2534 if you want to contact us here at the office. All this is scrolling below us. WCRF on Thursdays, 103.3 from 8 to 9. You can call in, text in, ask questions. And, of course, you can always text or email Corey, K-O-R-Y, at epsf.com if you have questions. There's a Fed meeting next week, and dare I say it, it is the most important Fed meeting of the year so far because they are going to raise 25 basis points. So we're going higher on interest rates. Mortgages will be entrenched well into the sevens, and I think they probably have one more rate hike this year. And the reason is, yes, inflation is coming down. It's still high. Even though it's coming down, the numbers, the year-over-year numbers are getting flatter and flatter. And you got to get to zero before you can come back a little bit and have prices reset somewhat. Excuse me. There's going to be no rate cuts this year. There's going to be no rate cuts the first half of next year. And I still do think we have a mild recession coming our way. What has to happen? The housing market has to capitulate a little bit. It's going to be tough to do that, though, because, for instance, I have a sub 3% mortgage. It's going to be really hard to convince me to sell my house to get a 7% mortgage when I have a lower than 3% mortgage. So the existing home market just not moving. That leaves only one area, which is new homes. And they can't really build homes fast enough. There's not enough people. So that has to kind of capitulate. That market has to collapse a little bit. And I think the employment market has to capitulate a little bit. We're at 3.8% unemployment. I think we're going to go to 4.5%. So that has to happen. Or we need to see negative inflation numbers, not deflation, but we need to see some resetting there. And I just don't see which one of those is going to happen. None of them is really happening right now. So I think the Fed has at least one more rate cut this year. So there are a lot of things going well, though. The stock market is going pretty good. Markets are up. We've had a great year so far. The first half of the year was a great year, and I would take it if we just stopped right now and clocked these numbers. I'd probably take it. But what's intriguing to me right now, there's several investments that are intriguing to me right now that maybe you want to consider. Government bonds, short term, year or less. Some of the telecoms. I kind of like Verizon because it's really beat up and they pay a nice dividend. There's the lead cable issue that they have, that there's a lot of litigation on right now. And I love large tech. I've loved large tech for a long time. In fact, large tech is really the thing that's keeping the market up. There's about 10 stocks that have really kept the market going. And then I loved unloved manufacturing. So I like to look at really good companies on really bad news. So in the pandemic, every company was in bad news because we thought we were going to zero and everybody was going to die and it was the zombie apocalypse. None of those things happened, and I felt fairly certain that because of the immediate response of the federal government with writing checks and PPP loans and things like that, that the recovery would be as voracious as the fall, and it almost was. Not exactly. The fall was very sharp, and we kind of climbed out slowly, a little slower out of the bottom, but we still climbed out, and we're way above that now, so I feel good about that. And then, so I like some of those things, big cap, as always, balance. You got to have some balance. I've had people come to me and say, I want to put half my money in this one stock. And I have to say, no, I cannot do that. It would be imprudent of me to do it. Now, if it was your account and just you doing it, well, you could do that, but it's not wise. You're betting so much in one direction. I don't do that with my own money. I don't think you should do it with your own money. I think 10% in an individual stock is about where I'd start saying, I got to protect this with an option of some kind. So balance. You've got to be balanced. It pays to talk to somebody, even if you have to pay to talk to somebody. It's okay. When you get your transmission fixed, you don't do it yourself, most likely, although some people I know do. I don't. You pay somebody. Don't be afraid to pay somebody. So some listener questions that I want to go over, and I love listener questions, love getting them. How about if you have a youth that's working, maybe a lifeguard or working at, they're a barista, all of a sudden they can make lattes. What about a Roth IRA? And I like the Roth IRA. For the younger you are, the better it is. So you got to have earned income to do a Roth IRA. So if you have a 16-year-old, they can open up a Roth IRA. And there's this philosophy that I like with money for anybody. It's save, spend, give. Okay, you want to save some of what you're making because it's always good to live off of about 75% of what you're making. Just is. Allow them to spend a little bit. You got to have some benefit from working, or why work? Some kids are saving for college and maybe they don't want to spend any money. I don't know. That's fine too if they don't, but allow that to happen. And then I think to get everybody into a habit of giving some away. Support a charity. Doesn't have to be mine. It could be anything that you want, but save, spend, give, and allow them to have some of that enjoyment of doing those things. But I like a Roth IRA. I like, with the money that you're not going to put in a Roth that you might be allocating to spending, shoes, video games, whatever, it could just be in a savings account. And then some rudimentary budget. Just, it doesn't have to be an Ernst & Young trial balance or anything like that. It just has to be a rudiment. Where are we spending? What are we saving? Let's keep track of things. Hey, and by the way, mom and dad, the best way to teach your kids is by example. They'll hear what we say, but they'll see what we do, and that's way more powerful. So if you want your kids to be good with money, be good with money. I understand that sometimes it takes some changes and all that. Doesn't have to be overnight. But if you're working towards something, they see those things, and that's a good thing. So, by example, my next question from a listener is leasing a car versus buying. Smart people lease cars to dumb people. Leasing a car is really only about 10% of the population will benefit from it. I recently just had in the office a little old lady and she leases a car. She drives about 10,000 miles a year or less, and so she can get a low mileage lease. Her husband is deceased. To me, that makes perfect sense. She's not paying a lot. She's got the resources to do it. She's not driving a Bentley on a lease. What was really compelling to people for leasing was that you could lease a car that you couldn't afford to buy. Well, this person could afford to buy the car, but they just want a car under warranty all the time. They don't ever want to have that again. She's part of the 10% that I think it really does work for. Now, it is true that in the pandemic, if you leased a car early 2020 or 2019, when you lease a car, the trade-in price, the buyout price is contractual. It's already in there. They know what you could buy that car for. So in a rare instance, people who were leasing cars could go out and sell that car in the open market and then pay the buyout price, and there would be profit margin there, sometimes $8,000-$10,000, especially if you took care of the car. So, but that's rare. It doesn't happen very often. And as soon as the car market normalizes, that will be gone. But while it's there, take it. So I think you're better off buying a little bit less car, paying for it, driving that car, and saving for the next car. Because we know cars last longer than they used to, but they don't last forever. So if you're in your 40s, you're going to be buying another car. So do it the right way. 1 or 2 year old car, pay it off as quick as you can, keep putting money away for the next car, and then maybe you'll get to the point at some time where you could pay cash for a car. And then when you're a little old lady who maybe it would make sense to lease a car, but if you're driving 20,000 miles a year, I don't think it makes sense. And then the last listener question was, should I pay off my 3% mortgage early in a lump sum? And my answer is no. At 3%, you're stealing from the bank, essentially. Somebody call the police. There's been a bank robbery. You're stealing from the bank at 3%. So what I would do, if you have that lump sum and enough money to pay off your mortgage, I would pay it a little faster, because even at 3%, there's a true cost to the mortgage, albeit small. But what you could do is, instead of just lump summing that and having no debts, which I love no debt, pay it off faster, maybe make an extra 3 or 4 mortgage payments over the year. So you say, okay, here's my mortgage payment. I'm going to increase it by this much a month so I get 3 extra payments a year. And then some of the other money that you're not using as a lump sum, put it into your diversified portfolio, because the time value of money is so powerful that the sooner you start and the longer you have, the less money you have to save to get to a goal. So I really like that. Do both at one time. Walk and chew gum. Come on, we could do this. Now, if you had a 9% mortgage, I might say, hey, I think it makes sense to pay that off. So to me, it's just the cost of money. At 3%, I feel relatively certain over time that I could beat that in the market. Now, last year we wouldn't have beat it in the market, but when you average the years out, I think you will beat it. So that's why I say don't pay that mortgage off early. But if you had a really high mortgage rate, or maybe you went to a car lot and you did a buy here, pay here loan, and you're paying 15% for a car, then I would pay those off. Yes, I would give a bullet to that debt and just take it out, because those are expensive debts. Remember, when you borrow money, it doesn't matter what it's for. It's just, what is the cost of the money? That's what matters. So the higher the cost of the money, the faster you want to pay it off. If you've got those high interest rate credit cards, you want to pay those off, because you could always go back to the credit card if you needed it. It's paid off. But now you could start power saving, and that 22% that you were paying to the credit card company, you could be putting that into your savings account. So the cost of money is what matters. It doesn't matter what the loan is for. So if somebody came to me and said, I want to sell you a car at 0% interest. They're not doing that right now, but if they did, I'd take that all day long. I'd be like, yeah, let's do 0%. It's not costing me anything out of pocket. They just want to sell a car. And you see those loans when there's a lot of supply. There isn't a dearth of supply right now in the auto market, or the home market, or just about any market. I don't know any market that's swimming in product right now, but it's getting better. Those things are going to come back, so you got to be ready for it. When that happens, if you have a listener question, if you have a question, comment, concern, you can see us on Twitter too. I read Twitter a lot. I don't post a lot on Twitter, but I read it a lot. But you could access us there. That's all scrolling down here. I am David Safransky, a real American, a true red-blooded patriot, and the voice you can trust.